Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, here we are. It's Friday again, and we're talking into the ether, I guess.
Well, Ethereum or Ethereum, because one of our questions here, our first question from a listener is from Michael, and it has to do with our imaginary or virtual money.
Yeah.
It seems that everything virtual or imaginary are within the new alternate reality of the markets. Virtual currencies are replacing gold. We have crypto art, collectibles replacing the physical, and fictional narratives such as modern monetary theory are replacing reality-based economic models. Market participants only have to collectively imagine Bitcoin going to $100,000 to make it eventually happen. Is this the new reality of the markets, or are we entering the Twilight Zone?
The Twilight Zone.
Yeah.
Yeah, Michael, good question. In a financial market of raging speculation, it's very difficult to determine what is real and what is unreal. And I've found that in decades of watching highly speculative stocks on the Vancouver Stock Exchange is that so long as the stock is going up, the public will believe even the most preposterous of stories. And many of them are not real. They're touts. They're in the future. So yeah, I like your imaginary and virtual. And then there's weird stuff going on with these crypto arts and art pieces that are somehow identified just through their little digital displacement or whatever. So very strange things going on. And you mentioned modern monetary theory. Well, currency depreciation is not modern. It's ancient, absolutely ancient. It's been on forever. So long as there's been a coinage, there will be governments desperate enough to depreciate the coinage. And I'm just reading about the Roman inflation in the 3rd century, and the denarius was a silver coin worth 1/1000th of a pound of silver. That was in the beginning, like in 200. And by the 300, it was just a wash of silver on the coinage. It was massive depreciation, but of course, the state did it in order to fund itself, where they could only realize so much from actual taxation. So all of this, there's no such thing as modern monetary theory. And you also mentioned Bitcoin going to 100,000. Well, who knows? These things can go anywhere, but there have been some outstanding price changes in the last. Well, let's step away from the crash into a year ago March, which was the first intentional massive hit to employment ever done by governments in the world. Now, that was extraordinary, but the way we're looking at it now is this boom. You've got the financial boom, which is outstanding, and also there are signs now showing of a boom in the physical world. And I'm taking this as the end of a great bubble where you do have strength in industrial commodities, in residential real estate, as a great financial mania reaches a peak. So we'll see how all this turns out. And the new reality, Michael, and you mentioned the term Twilight Zone. I used the Twilight Zone in yesterday's regular weekly piece. So, yeah, I think we're in the sunshine zone now, and after mid-year you can get seasonal changes, and then after August, I think we're looking at the Twilight Zone in the fall.
Well, some NBA franchises are offering to pay their players in Bitcoin. Why would a team do that? Are they betting that the price of Bitcoin will go down and save them money, and the players are betting it's going to go up?
I think it's just a fad. Yeah. Mm-hmm.
And what happens, Bob, if there's a massive power failure and you can't access that crypto money anymore?
I tell you, Jim, you don't even want to think about that. This whole Bitcoin thing. Now, I think the Bitcoin and blockchain are important, and I think out of it, a currency of relatively constant value could be developed. But the Bitcoin phenomenon now is a speculative item, and it's certainly not a currency of relatively constant value. And the whole world, the whole of the business and retail world needs a currency of constant value. And there have been hundreds of years when in the senior countries such as England was on a gold standard. So it was as constant as you could get. And of course what we're on now is a PhD constant. It's dependent on what some 500 PhD economists in the Fed are thinking today. Absolutely ridiculous. So, but I think that society is heading for a reform of corrupt governments, and that corrupt governments have been using corrupt currency, and the currency and central banking will be reformed as well. Yeah, I think let's look to the bright side.
Our second question of the day comes from I say Cecil, you say Cecil.
Yep.
Hi, Bob. With the markets continuing to go higher and higher, I'm starting to wonder if there's really much of a correction, or if there is, will it just return the major indices to the levels that they were up to before? Many of the biggest bears have been predicting a 50% market crash. If the S&P doubles in a year or so to 4,500, a 50% correction really isn't that bad.
I gotta intrude. You don't want to be in a 50% correction, or you don't want to be fully invested. Let's put it this way.
Well, you buy the dips, don't you?
Yeah.
Yeah, and that's a hell of a dip. Is this how markets usually correct, 50% at a time, or should we be basing any corrections on where the markets took off from, say 2,500 for the S&P? If we go high enough, such a correction would be minor to a lot of people. Does a higher high in the indices help negate the fears of an S&P below 2,500 or even 2,000? I'm confused and getting fear of missing out with market action. Thanks, says Cecil. Perhaps they want to send a pronouncer next time.
Oh, fear of missing out, yeah.
Yeah.
Actually, your question is to the point, and it reminds me of a story. I think it was in the New York Times, early September of 1929. And the writer was pointing out, obviously a financial writer, that each of the corrections you should have bought rather than lose all your position on perhaps the previous strong rally. And the part of the essay could have included that this was perhaps a new world and all that sort of stuff. But I think that this speculation now has all of the signs of a classic great financial bubble. And on our work, historically, this could conclude in this year, because there's been sort of a decade relationship between a previous speculation in commodities. And remember, in 2011, we had silver and gold to the moon, and prices of other base metals were very good, high and stuff like that. And here we are a decade later, where the party is essentially in financial items with an accompanying rally in commodities, particularly out of last year's crash. So to me, this looks like 1929, and we have a model that we call that gives us springboard buys in a and it's designed to catch the corrections within a rising trend or even a flat trend. And so this then gives technical assistance to buying the dips. And ironically, we had one in March on the S&P, but you don't know ahead of time when you're going to get the last springboard buy. And you don't know it, and this was the case in 2007 as well. You had springboard buys on each of the corrections all the way up, and then you had the one that took out the last. So you don't know when your last springboard buy in a mature market until it's taken out, but you do have technical means of saying that the market is maturing, and then you look for signs about when the market could roll over, and we're thinking after mid-year. The various party items will have exhausted themselves, and enough would be going down such that you get into a fairly heavy correction, if not a bear market, after August. So it's time to be wary. And the appearance of liquidity, like there's huge bids for everything, but in that a lot of those bids are by highly aggressive speculators, and they're leveraged, so they're on borrowed money. So really, it goes back to Michael's question. It's unreal money that's behind the bid in a highly speculative market. But I think more work over the next month or so, and the work that we're doing technically, we should be able to make a pretty good call on just how severe the next leg down would be.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob will be taking a look at some of the headlines you dug up for us today. The first one, America's biggest boom since 1946. We're not talking about atomic bomb tests, are we?
Jim, that's funny. Actually, this is from the Axios site, which is very democratic. So this was a headline they would not have used when Trump was in office, but because Biden's in office, you can now. But there is strong economic numbers out there that are accompanying an incredibly speculative financial market. So what I collected in these headlines is headlines about the boom, which is on, and then there are headlines about some speculators getting hit, which could mark the transition to the boom becoming a bust.
Another headline, home prices soar in the U.S. because of a small supply of homes. In Canada, we're seeing the same phenomena. Now even condos are going up in price. Is this 2016 all over again, Bob?
Well, it could be. It's very wild. And then in the U.S., you had their huge peak in residential home prices in 2006, 2007. That that was something. And then in Canada, like your major cities, Toronto and Vancouver, you had so much Asian buying that the markets didn't get hit. But in many centers in the United States, there wasn't the equivalent Asian buying, and real estate prices got hit fairly severely. But then they're now in areas back to new highs. So, and as the headline says, a frenzied U.S. market. So,
in Canada, Steve Saretsky, friend of the show, pointed out, yes, he said everything is booming except luxury real estate in Vancouver. He said if you can call a property that's worth $12 million a bargain, then he said you still have a chance and a good selection of properties to do if you like to hang off a cliff with a great view of the ocean.
Yeah. Oh, yeah, there were great advances in prices there along Point Grey Road. Whoa. Yeah, there were some prices. I remember one, well, out towards the university with the view over the ocean and up Howe Sound went for $30 million.
You're in Chip Wilson, Mr. Lululemon territory around there, aren't you?
Yeah, actually, decades ago, twice I lived right on the water on Point Grey Road. It was very pleasant. I like it a lot.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Just like its cheese, Credit Suisse's bank account is now full of holes after a major failure, a $4.7 billion hit. What's the story there?
Yeah, Credit Suisse, of course, is a very important bank, and it took a $4.7 billion market hit on the fund guide on Harkigos, I guess that's how it's pronounced, where he highly leveraged and bang, it reversed. So this is the point in this week's headlines is headlines about boom and headlines about reversals where certain over-leveraged people are getting hit.
And an individual, Bill Wang, H-W-A-N-G, a $20 billion loss, and he's wiped out. What happened to poor Bill? Do we have to have a sticker day for him?
Archegos, which...
Oh, so that's connected.
Yeah, it's with the Credit Suisse and other problems. So he had run up a hedge fund of $20 billion, and as Bloomberg headline of the other day says, then lost it all in 2 trading days. And, that is astounding. Maybe it was 5 or 6 trading days, but the headline was 2 trading days. So that would be enough to break it, and then the rest was probably just fallout. So this is what can happen. And you've got also, I remember we talked about this, is the other aggressive fund out of England, Greensill, and then the very aggressive industrial powerhouse guy, Gupta, in India. And this other headline is an intertwined empire had for years raised concerns internationally about what risky stuff they were doing. But when you got a straight-up market and recklessness is rewarded, or recklessness will be employed. And this one with Gupta reminds me of in 1929, in England, there was a very aggressive speculator. His name was Clarence Hattree. He was a boom and bust guy until you had the long 1929 bubble, and then he made a lot of money, and early in 1929, he was proposing to take over an important British steel company, and thought he had financing set up for it. And then as 1929 progressed, he found that some of the people that would join him in the game started to back out, and then he knew that he was in extreme trouble. So maybe it was in June or July or something like that, he realized that this is going to be a huge disaster in the London market. So he got word through to the head of, or the governor of the Bank of England then, that he needed a bailout, and if he failed, it could bring the market down. Well, the Bank of England was not going to accommodate him because he was sort of outside the pale of being too much of an independent speculator. So there was no assistance, and indeed some headlines in September and October in London did lay the blame of the crash upon Hattry's specific problem. But this then is an example of how you can explain why the central bank as a lender of last resort never works. Is because it's not just one agency or one speculator that gets over-leveraged. In a way, everybody gets over-leveraged. So the concept of a central bank, such as the Bank of Canada or the Federal Reserve, being there as the lender of last resort, and this goes back to before the formation of the Fed in 1913, is that the establishment then knew that if you had a financial crisis, it would be followed by a recession. So then they gave the Federal Reserve mystical powers that by being a lender of last resort, it would prevent a financial crisis and therefore prevent recessions. So until recently, there's been 18 recessions in the United States. So the theory is very appealing. Jim, I'll admit that the theory of having an agency that's going to prevent financial crises and prevent recessions is a wonderful idea. It's very attractive. But it has never worked. And the reason why it never works and never will work is that it rests upon one agent getting in trouble and the central bank fixing it. But this is never the case because hundreds, if not thousands, of speculators, big ones, get over-leveraged, and this guy, Bill Hoye, went from a hedge fund of $20 billion and lost most of it in 2 trading days. So, and then they happened so fast.
I was going to say, Bob, once the short sellers see you're in trouble, that's it. You're doomed. The margin clerks go to work, don't they?
Oh, yeah. The margin clerks are there. So in 1873, they tout in the summer of that bubble, leading New York newspaper editorialized that nothing could go wrong. And the reason is that the United States did not have a central bank constrained by gold. It had, they called it the national banking system or the treasury system, and the U.S. was on paper currency, no gold standard. So then the head of the treasury would then be able to inject all kinds of cash into the market if it needed it by buying bonds out of the market. And that was the comfort given that said that the market would keep going. And then, of course, in that fall, actually it's interesting because on that one, like 1929, the last speculative thrust was into early September. And then it all came apart. So you had a theory there that nothing could go wrong because the U.S. did not have a central bank. Then in 1929, John Moody, in an essay in the Atlantic Monthly, rationalized that nothing could go wrong because you had a new and scientific central bank. And then in 2007, nothing could go wrong because the Federal Reserve had learned from its mistakes of 1929, and then you had a crash anyway. So one of the worst things you can see is a responsible financial newspaper or agency saying that nothing could go wrong and explaining the reason why nothing could go wrong, and it never works. So I'm watching for some of those headlines now. But what we've now got is headlines heralding the strength of the boom, at the same time recording that highly leveraged speculators are suddenly getting into trouble. Now, markets can usually be favorable into around May or June, and there's the old saying about sell in May and go away. And then if you're going to have a financial problem, it usually appears in the fall. So this is where sometime after mid-year, all the positive stuff going on now could become rather doubtful. And again, our technical work will be watching for the actual precision on the break in the markets.
Risky borrowers are now falling behind in their car payments. How long before they default? And there's some cheap used cars on the market.
Well, even used car prices have gone straight up, and the risky borrowers. So this is a good headline because it describes what's happened with just the guy down the street or the guy in the next town. Effectively, probably over-leveraged, and you go all the way to Bill Wang, who just had a $20 billion margin call. The only difference is size, and it all adds up to where major speculators are getting hit, and people at the lower end of the spectrum who are leveraged on car loans or house mortgages may be becoming precarious themselves. So, and this is all classic business and credit cycle examples of everybody gets in and then everybody gets out.
Bob, one of the reasons they said house prices in the U.S. have gone up dramatically and there's a scarce supply is that because of the moratorium on mortgages being called in or defaulting, there's no foreclosed houses for people to buy. Cheap foreclosed houses. That supply is dried up.
Yeah, that's one of them. The other one is that the downtown residential parts of many cities, particularly in the states, Democrat-run cities, have become hellholes. Even New York City downtown is becoming a hellhole, and people are leaving. And then they're moving into outlying communities, and suddenly, so they've bought up all the housing there, and contractors are going to work building new ones, and people are renovating the one they move into. So this is what's driven lumber up to over $1,000 a board feet, which is not boring. So, yeah, it's another example of extraordinary speculation. And also, you go back to the 1920s bull market, the extraordinary residential speculation focused on possible homes and home development's going to be done in Florida. Huge mania, but that one I think peaked in 1927, and then a hurricane hit it, so then that was the major hit. But then, after 1929, on the contraction, house prices and commercial and industrial real estate prices went down for a long time. And, I know one, going back to the 1873 bubble in England, which was the senior economy then. I did find years ago a chart showing farmland values in England plotted annually from the peak of the bubble in 1873 to the end of that depression in 1896. And that index might have been a number in my mind, 58, and it fell to, say, 38 in the 20 years, with virtually every year being a down year. And this is, of course, property would have been bid up in the global financial bubble mania that completed in 1873. So the difference between 1873 and 1929 is that it was more participants in the 1929 bubble, and then of course now this has been without a doubt the greatest financial bubble in history. Absolutely incredible. I'm very pleased to be alert and aware of it as we go through this.
Bob, thank you so much for speaking with us.
Yeah, Jim, always good to get together, and we're looking forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.